The tone of the real estate finance market has taken a distinct turn versus 2015. This period, with ample sources of capital, very low cap rates, and high valuations, have set the stage for 2016, but the impact of coming regulations is yet to be factored in. Collateralized mortgage-backed securities, one major source of capital, is now bracing for two new regulations that take effect in the fourth quarter. One is called risk retention, where underwriters are required to retain part of the risk as they sell it out into the secondary market. It's a new concept, and it came out of the 2008 era, where players sold off obligations, leaving the buyer with all the risk. The second new regulation requires senior individuals to literally sign off on the quality of the CMBS loan product. The market is struggling to interpret these specifics, thus creating turmoil. As a result of the largely unknowable fourth quarter, many CMBS originators are clearing inventory in order to help divert any potential risk that may be exposed by these new regulations. That could siphon off a lot of liquidity needed to refinance loans. We've been observing the difference in yields across major cities such as New York and Los Angeles versus smaller urban areas. As interest rates begin to climb, the ROI of a deal will take a notable dip. With real estate opportunities found in a secondary or tertiary market, often the asset can be acquired at more favorable terms. So a Class B multifamily garden apartment in a market like Pittsburgh would probably trade at a 6% cap rate or a very reasonable valuation. On the other hand, a Class A asset in northern New Jersey would trade around a 3.75% cap rate or a very high valuation. The right assets in secondary markets can be a very attractive place to invest. In any event, these deals and the banks need a liquid CMBS market to be repaid. On a positive note, employment growth has been smooth and steady, which is a great thing for real estate. As long as we have only gradual increases in interest rates and continued modest increases in employment, the market will operate smoothly. The tone of the market is shifting. The U.S. real estate market remains one of the most attractive sectors for any internationally sourced funds.